Hello there, this is Victor here. Welcome to the Intelligent Investor channel. The market has started recovering this year from the most recent bottom. At the time of making this video, the S&P 500 has recovered about 15% from the most recent bottom, and the Nasdaq 100 has recovered about 18% from the most recent bottom here. As an investor, you will want to know, is this a bear market rally? Is this going to be a bull market going forward? And will the Fed start lowering interest rates soon so that the market will rally even more? In this video, I'm going to talk about these topics to see if the market is recovering too soon and to see if the Fed is bluffing now. First, I will give you a quick update about one of my growth stock portfolios. Then I will talk about is the Fed bluffing and are we seeing a bear market rally. If you like this video, make sure to hit the like button, subscribe and turn on the notification button. I will continue to make many excellent investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. Here's an update about one of my growth stock portfolios here. At the time of making this video, I'm managing several personal growth stock portfolios between me and my wife at around $1.1 million now. My other growth stock portfolios have the same stocks and the same investing strategy. My personal goal for this growth stock portfolio is to grow it to over $10 million over time. Initially, I want this portfolio to have more growth stocks so it can grow faster over the long run. But later, as this portfolio grows larger, I will want it to have more dividend growth stocks because I want this portfolio to earn a lot more passive dividends every quarter while it still grows consistently over the long run. Here's my investing strategy for this portfolio. Always invest in the best companies at wonderful prices. The best companies are the companies that have wide economic moats and durable competitive advantage, increasing earnings and increasing free cash flows over time, high return on invested capital, and of course, great management. I will invest in a company only when the stock is below its intrinsic business value with a good margin of safety. This is very similar to Warren Buffett's investing strategy. Buffett wrote this in his 2021 shareholder letter. Our goal is to have meaningful investments in businesses with both durable economic advantage and a first-class CEO. Charlie and I are not stock pickers, we're business pickers. Buy pieces of wonderful businesses at wonderful prices. In my opinion, I think there's a very good chance of this portfolio beating the S&P 500 over the long run because I have invested in some of the best businesses that are mostly in the US, and I have bought many of them when they were substantially undervalued. For example, I bought Apple, Google, Microsoft, MasterCard, and Visa when they were substantially undervalued. You may notice that I mainly invest in tech companies because I understand tech companies the most. I like to stay within my circle of competencies and invest in the best companies I understand the most. I believe the big tech companies such as Apple, Google, Microsoft, Tesla, TSMC, and ASML are the most competitive companies. In my opinion, they tend to have high earnings growth potential and wide economic moats over the long run. It's very hard for competitors to compete with these companies because these companies tend to have very durable competitive advantage such as branding, ecosystems, technologies, network effects, and economies of scale that are almost impossible for competitors to duplicate. For example, according to Morningstar, Apple, Google, Microsoft, TSMC, and ASML all have wide economic moats. Only Tesla still has a narrow economic moat. Obviously, the market, especially the tech sector as represented by the Nasdaq 100, is still down a lot from the most recent peak. We have to be forward-looking when we invest in stocks. Going forward, as the US inflation continues to improve, hopefully every month, the Fed will eventually pivot and start lowering interest rates either by the end of 2023 or sometime in 2024. As inflation improves and as the Fed pauses rate increases, the market will eventually recover even more. I do expect all the tech stocks and growth stocks will eventually recover a lot because the Fed will eventually lower rates again. In my opinion, it will just be a matter of time before we see a large bull market, especially in the tech sector. Going forward, my plan is still the same. continue to invest in the best companies at wonderful prices or undervalued prices every month. For example, I like to add at least $1,000 to this growth stock portfolio every month and buy more Apple, Google, Microsoft, Visa, MasterCard, American Express, TSMC, ASML, and Tesla shares going forward whenever they become undervalued. In most cases, once I invest in a company such as Apple, Google, and Microsoft, I don't trade the stock. I think it's important to invest like a business owner and not invest like a stock trader. Once I buy shares of an outstanding company, I like to own the business and let the company's intrinsic business value grow over time. Once you invest in a great company such as Apple, you will want to own the business and not trade it every few months or even a few days, because you will want the outstanding company you invest in to grow substantially and compound over the long run. I'm using Apple as an example here. If it's an outstanding company with durable competitive advantage and great management, you will see the company's earnings, free cash flows, and of course its stock value grow substantially over the long run. Compound interest is a long-term investor's best friend. The great Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. The greatest investor of our time, Warren Buffett, also said, my wealth has come from a combination of living in America, some lucky genes, and compound interest. So is the Fed really bluffing about increasing rates more this year and not lowering rates until sometime in 2024? As of now, the market believes the Fed is bluffing and believes the Fed will likely start lowering rates by the end of the year and not wait until 2024. This is because the market thinks that inflation is decreasing much faster than the Fed is forecasting. Also, the market thinks the Fed does not want the stock market as represented by the S&P 500 to recover so quickly. This is because higher stock prices will ease many financial conditions, make consumers spend more, make businesses invest more, and make it harder for the Fed to bring inflation back down to the 2% target. At the time of making this video, the US PC inflation is at 5%, so there is still a long way for the Fed to bring inflation back to the 2% target. According to the CME Fed Watch tool here, the Fed is expected to raise its Fed funds rate by another 0.25% in the March meeting. Then the Fed will likely raise its rate by another 0.25% in the May meeting. This means the Fed's interest rate is expected to peak between 5% and 5.25% this year. The market also expects that the Fed will start lowering rates by the end of the year. Of course, this assumes there are no large surprises in the upcoming job market and inflation data. The market's rates forecast is very different from the Fed's rates forecast. The Fed Chair Jerome Powell said several times that he does not expect the Fed to lower interest rates in 2023. But what we know is that the market will recover very quickly when the Fed starts to pause interest rates and eventually lower interest rates. Personally, I don't think the Fed is bluffing. I believe the Fed will not lower rates until at least sometime in 2024 when they see inflation comes down significantly in a sustained way to the 2% target. According to the latest FOMC meeting, Jerome Powell said, we have a sector that represents 56% of the core inflation index where we don't see this inflation yet. So we don't see it. It's not happening yet. Inflation in that core services, excluding housing, is still running at 4% on a 6 and 12 months basis. I'll share with you the most important parts of the recent FOMC rate announcement. I think it's important to understand the Fed's inflation expectation and rate forecast going forward. There's a saying, don't fight the Fed.
My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far what we see is progress, but without any weakening in labor market conditions. I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
According to the Wall Street Journal and the latest job data here, the US unemployment rate has fallen to 3.4%, which is the lowest in 53 years since 1969. The US added a lot more jobs in January than what the market initially forecasted. This suggests that the job market, especially the services sector, is still very tight. There are still many more job openings in the services sector than the number of people available to work. Because of the latest job report, I don't think the Fed is bluffing. I think it's still too early for the Fed to start pausing rates. So is this a bear market rally? Will the market have large corrections again, or will it be a bull market going forward? Honestly, I cannot predict what the market will do in the short term. I don't think anyone can predict the market accurately, not even Michael Burry, who is considered one of the best contrarian investors. I think the market is very unpredictable. Not even Warren Buffett and Charlie Munger can predict what the market will do the next day, next week, next month, or 1 year later. As a long-term investor, I believe what is more important than predicting the market is to always invest in the best companies we can find and invest only when they're undervalued to reduce risks. I think many investors, probably more than 90% of the investors, make the mistake of buying stocks when they think the market is likely to go up and selling stocks when they believe the market is likely to go down in the short term. In my opinion, this is not real investing. This is speculating on stock prices. Buying stocks when we think the market will go up and selling stocks when we think the market will go down in the short term is actually no different from gambling in a casino. The market can be very unpredictable in the short term. The market can be very depressing in 1 week and very optimistic in another week, even if company fundamentals and the economy have not changed much. Personally, I think one of the best ways to take advantage of this market is to stay invested in the best companies that are undervalued. I said this earlier, the best companies have large economic moats, durable competitive advantage, increasing earnings and increasing free cash flows over time, high return on invested capital, and great management. I cannot predict whether this is only a bear market rally or this is actually the beginning of a bull market. If the market continues to rally because inflation is decreasing faster than the Fed is forecasting, my growth stock portfolio here will grow a lot because most of the companies in this portfolio are large cap tech stocks. Tech stocks in general tend to perform very well when it's a bull market and when the Fed is lowering rates to boost economic growth. But if inflation is still very high and if the Fed is increasing rates higher than the market's forecast, then the market will likely have more large corrections going forward. If this happens, many tech stocks will likely have more corrections going forward. If this actually happens, I will buy more Apple, Google, Microsoft, Visa, MasterCard, American Express, TSMC, ASML, Tesla, and even Meta shares because many of them will likely become substantially undervalued again. Before ending this video, I will share with you this from Warren Buffett's 1987 shareholder letter. Following Ben's teachings, Charlie and I let our marketable equities tell us by their operating results, not by their daily or even yearly price quotations, whether our investments are successful. The market may ignore business success for a while, but eventually will confirm it. As Ben said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. The speed at which a business success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at our bargain price. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.